Let's talk about one of the most dangerous choke points in the global economy. 33 kilometers wide. That's it. 33 kilometers of water between Iran, Oman, and the UAE. And through it flows almost 20% of the world's oil supply. 17 million barrels a day. If that passage, the Strait of Hormuz, is blocked, we aren't talking about a regional problem. We're talking about a global economic shockwave. And I want to unpack what that really means, not as a headline, but as a strategist, because I've lived and worked in the region. I speak Arabic. I've worked in Iraq and the UAE as a diplomat and as a management consultant. I've sat in rooms where energy security wasn't theoretical. It was existential. So let's get serious about this. Oil from 8 Gulf countries transits this narrow corridor. For some of them, it's not a lot. It's nearly everything. Saudi Arabia, Kuwait, and Qatar send about 90% of their oil exports through that strait. They depend on it. And when you build your national revenue model around a single maritime artery, you create vulnerability. Now let's talk impact. Because when mid-market CEOs asked us, well, will this affect us? The answer is almost always yes. The only question is how fast and how much. India imports 85% of its oil and 60% of that comes from the Middle East. If Hormuz closes, Indian fuel prices spike. Manufacturing costs surge. Transport costs surge. Food prices surge. Inflation becomes political. And India is not some peripheral economy. It's central to global services, pharmaceuticals, manufacturing supply chains. Shock India and the ripple moves fast. China imports roughly 10 million barrels of oil per day, and about 40% of its oil imports pass through Hormuz. China has built pipelines to Russia and Central Asia, yes, but they don't even cover 20% of its energy needs. So if Hormuz closes, China's growth slows. And when China slows, global demand contracts, which means commodity exporters get hit, which means manufacturing demand falls, which means your stable international sales forecast just evaporated. Japan imports 90% of its oil and 75% of that passes through Hormuz. Japan is a critical node in high-end manufacturing, automotive, advanced materials. Energy shock equals industrial shock. Here's the real irony. Saudi Arabia itself would be severely hit. Between 80 to 90% of its oil exports go through the Strait of Hormuz. Imagine losing 80 to 90% of national revenue overnight. That's potentially regime-level instability. And if Riyadh deploys military force to reopen the route, which it could, escalation becomes far more likely. This is how regional conflict becomes global. The UAE relies on the Strait of Hormuz for about 72% of its oil exports. Yes, they did build the Habshan-Fujairah pipeline to bypass Hormuz, and it can handle about 60% of exports. That's smart statecraft. But it's not full insulation. And having worked there, I can tell you, Emirati leadership thinks long term. They prepare, they plan, they diversify, but even the best prepared Gulf state cannot fully decouple from Hormuz. Experts warn that oil could spike past $150 a barrel. Let me translate that. Inflation returns aggressively. Central banks are trapped. Shipping costs rise. Insurance premiums surge. Highly leveraged companies suffer first. And yes, recession risk becomes real. At Deeren & Associates, we advise mid-market firms operating internationally. And here's what really frustrates me. Most companies treat geopolitics as background noise. It's not background noise, it's operating environment. If you source inputs from Asia, export to Europe, manufacture in the Middle East, rely on petrochemical feedstocks, depend on global shipping, then Hormuz matters to you. Even if you're sitting in Melbourne, Chicago, Munich, or Singapore, it's relevant. Here are some strategic questions you should be asking right now. Not will it happen, but what's our exposure to energy price volatility? What percentage of our supply chain ultimately depends on Asian manufacturing? How sensitive are our margins to freight cost spikes? Do we have pricing power? Do we have alternative suppliers? Have we stress tested a $150 a barrel oil scenario? Because geopolitical risk is not about predicting war. It's about building resilience before the shock. I've lived in the Gulf. I've worked with ministries. I've seen how quickly things can shift. The Strait of Hormuz is 33 kilometers wide, but its strategic significance is enormous. If it closes, even temporarily, the impact won't be regional. It will be systemic. And in a world already fragile financially, politically, socially, that matters. If you're a mid-market company operating internationally and you're not actively scenario planning today around geopolitical choke points like this, you're not managing risk. You're just ignoring it. And that's not a strategy. If you'd like to understand your exposure to geopolitical volatility, not just in the Middle East, but globally, check out the blueprint for international success at deerenassociates.com/blueprint. This has been Global Fault Lines, and trust me, the fault lines are shifting.